Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
We've got our incredible Yahoo finance team ringing in the opening bell this morning. Great to see all of those familiar faces.
The strength of the economy has been really robust, and so you have elevated volatility, strong economic outlook, and really continuing to strengthen economic outlook. All of those are really, really positive for investment banks.
This March report on retail sales, we had some upward revisions and the numbers came in much better than expected. So I think in this environment, the Fed is simply going to be, pushing back in terms of when they would likely start to entertain any kind of a notion of easing monetary policy.
The Biden administration and Europeans and others have been working hard since this crisis began to try to keep it from ending in an endgame of a direct confrontation, Iran, Israel. If that were to happen, it would be a far more serious market event.
We've got 1 hour to go until the market close. Let's take a look at the major averages and how we got here. Now, in the case of the Dow, we have definitely seen a sharp deceleration, whereas stocks opened higher and then drifted lower. There was a more sharp move downward. That was coincident with some headlines coming out from the Times of Israel that were then picked up by the Associated Press here in the United States that pointed to senior Israeli officials saying there would have to be some kind of reciprocation or reciprocal move to the Iranian strikes in Israel over the weekend, although the report sort of couching it and saying they did not want it to spill over and become a wider conflict. All of that said, the market watching these developments very, very closely, but that seemed to coincide with the drop that we saw, the further drop that we saw in markets today. The S&P 500 also trading lower by more than 1%. The Nasdaq, the worst of the three, down by 1.6%. Now, there's other things that we have to talk about today as well, because this morning we got retail sales that came in hotter than had been anticipated, rising more than expected, but also February numbers being revised higher, showing that there's still strong demand for goods. And so we see a big, big move upward again in the 10-year yield, up 13 basis points again today. Now, we've been seeing moves like that consistent throughout the day that didn't affect stocks until we get those new Israel headlines. And then finally, got to check on what's going on in the oil markets as well here. Here's WTI. Now, it's still lower, but obviously coming way up from its lows of the session, again, after we got these headlines, Josh.
So, Julie, let's check in on a stock to watch, and let's begin with Tesla here. Big news today. One, we got news of job cuts, and significant ones. Could reduce headcount by more than 10%. Potentially, we're talking about more than 14,000 people globally. Could maybe even be closer to 20% in certain divisions. That is per Bloomberg, citing sources. Elon Musk, in an email to staff, Julie, talking about cost reductions, improving profitability. There is nothing I hate more, Musk says, but it must be done. In addition to that, apparently two senior execs have left the company. That includes one who did help lead engineering and tech development for the company's batteries, motors, and energy products. Not clear per reports whether their exits connected to Tesla's broader headwinds. We know earlier this month, though, of course, Tesla reported missed on deliveries, but the stock meaningfully down in today's trade.
Yeah, and it seemed like that the departures, the executive departures, particularly of the gentleman who was the vice president, Drew Baglino, who was sort of in charge of powertrain technology there, that was unexpected for the market, and therefore the layoffs not necessarily as unexpected, but his departure was. And looking at some of the analyst commentary, that seems to be a particular source of concern here. The stock is now down more than 30% year to date. And even Tesla bull Dan Ives is out with a comment today saying that the departure of Baglino is an absolute gut punch loss in our view, since he was instrumental in the powertrain and energy initiatives of Tesla. Yeah. he's still an outperform on the stock.
sure.
But the drumbeat of his negative commentary has gotten louder.
Yeah, I mean, I remember Tesla job cuts in the past, but this feels different. I don't remember ones that seem this significant. But listen, comes at a time of just, these persistent headwinds, just slowing EV demand, no signs of letting up, the price wars in China, so a number of challenges for Tesla investors.
For sure. Let's broaden it back out and talk about what's going on in markets more broadly today, as stocks, as I just pointed out, are near the lows of the day. Investor sentiment tipping back toward fear, rising tensions in the Mideast from strong economic data here at home. Bond yields have been surging as the world waits on how Israel will retaliate against that unprecedented strike from Iran. Israel's military chief of staff saying there will be a response of some kind. Joining us now, Liz Young, SoFi head of investment strategy. Liz, thank you so much for being here. Obviously, a lot to sift through today. You've got the headlines coming from the Mideast. You have that stronger than expected economic data here. Oh, and by the way, it's also earnings season. So how are you thinking about all these issues?
There's a lot going on out there, and this day so far has been complete whiplash. We began it really with the relief of maybe not an escalated tension in the Middle East, and then gave all of that back pretty much when we found out that maybe it isn't over after all. So it's hard to argue that after last weekend things have gotten better, but we are heading into the busier part of earnings season where we'll get really the data from companies that the rubber hits the road. I think we're in a place right now in the market where we are priced for a pretty good environment. And that doesn't necessarily make that super risky, but what it does say is that earnings have to come through at least as strong as investors expect them to, if not stronger. And we've already seen with some of the banks that if guidance isn't as strong as investors want it to be, they've been punished. So if that theme persists throughout earnings season, the multiple on the S&P right now could be at risk.
And Liz, bring it back. I mean, geopolitics front and center today. And the world to a lot of folks, Liz, right now probably looks kind of fragile. And it's not just, Israel, Iran, it is Russia, Ukraine, it is China, Taiwan, it is Israel, Hamas. As a strategist, Liz, how do you think through these geopolitical tensions?
Yeah, I mean, it's difficult to step back and try to take just a purely investment take on it. But something that was going on even before the heightened risk over the weekend was that there was a lot of currency volatility. We have central banks around the globe starting to move in different directions, which just raises the risk of currency volatility, and it just raises the question marks. We have really big regions thinking about moving in different directions. We've got Japan on the upswing, we've got the US maybe at some point cutting rates, but that just it raises all of those bumps in the road in currencies. So that's first and foremost what I watch as a strategist. You also watch things like gold, which we know has been on an absolute surge this year, and commodities. And commodities and gold are something that are traded around the globe, and they're important to a lot of global nations in different ways. They're also important to inflation and the trajectory of inflation. And what we've seen, regardless of the fact that we've been seeing growth in inflation come down, we've seen commodities surge this year, which puts a lot of pressure, particularly on the Fed, to stay tighter and higher for longer. And that affects a lot of the globe as well.
Of course, markets have been dealing with the idea that the Fed might be on hold for longer. All things considered, relatively well if you look at the equity market. When does that become more problematic, though? Or does it become more problematic? I mean, especially as we continue to see bond yields rise.
Well, I think that last part is what you just hit it on the head. As yields have risen, it seems like there was a threshold somewhere between 4.4 and 4.5 on the 10-year yield where stocks were no longer digesting it in a positive way. And now we've got the correlation between the 10-year yield and PEs turning negative again. We've got stocks going down as yields go up. And that is normally how the relationship works. Now, this doesn't necessarily mean that there's these huge alarm bells going off. This is, as we know, coming off the heels of a really, really strong rally that started at the end of last year. So giving a little bit back here because valuations seem a little frothy is not a bad thing, and I think would be very natural, even regardless of geopolitical risk. So this isn't something that's sending signals, even when you look at the internals of the market, it's not sending alarm signals yet that say things are really at risk. But I do think there needs to be some right sizing of stock valuations, given the idea that we've moved from 6 cuts to possibly 2 cuts this year, or the possibility of not having any cuts this year, and capital staying tighter and more expensive than we originally thought it might.
And Liz, on that possibility of no cuts this year, it's just interesting to see the number of strategists who are kind of coming around to that as their base case. Torsten Slok, Ed Yardeni. No cuts this year, Liz. Can the market still move higher?
If yields stay in check, I think the market can at least chug along for a while. So the period between the last hike and the first cut, the market usually does okay. It's that first cut and the reason for the first cut that can give the market a lot of trepidation. But this period in between can be okay, if not positive, for markets. We've already seen a lot of positivity. That's really the issue right now, is that we've seen a lot of the upside. Is that all we might get? And then we go through a sideways period, absent bad news. Now, I don't know that we're not going to get bad news for the rest of the year. I think that the economy will slow a bit. Everybody is projecting that, just hoping that it only slows a little bit without completely freezing up. So if we don't get cuts this year, and if yields stay in check, I think the stock market can do okay. And always remember, I know you guys remind people of this all the time too, a 10% correction happens every year on average, and that is an okay thing. So nothing to get too freaked out about in the near term, but we do need yields to lower the volatility, at least in the Treasury market right now.
Liz, great to see you. Thanks so much.
Thank you.
We're just getting started here on market domination. Coming up, Iran launching an unprecedented air attack against military facilities in Israel Saturday night. We'll discuss the implications and what could happen next on the other side. Stick around, more market domination still to come.
Iran's attack on Israel over the weekend has many on Wall Street concerned about growing conflict now in the Middle East. Joining us now is Carmiel Arbit, Senior Fellow for Middle East Programs at the Atlantic Council. Carmiel, it is great to see you. So the Biden administration, Carmiel, is reportedly pressuring Israel to show restraint after this Iranian attack over the weekend. How do you think, Carmiel, the Israelis will respond?
Yeah, I think that U.S. pressure is only one of three main considerations the Israelis are going to have while they think through the appropriate response. The first thing on Israel's mind is restoring deterrence, how to ensure that Israel is sending a message to the region that it will not tolerate this type of attack on its sovereignty on Israeli soil, which was really unprecedented. The second consideration for the Israelis is whether or not they have an ability to be in a major three-front war. Let's not forget the war continues in Gaza right now. There are also continuing skirmishes back and forth between Israel and Iranian proxies like Hezbollah. And then I think the third consideration will be whether or not the U.S. would support any kind of operation, which it is indicating it will not.
And so is it possible to thread that needle? How does Israel do that?
Yeah, I think Israel has a number of different options in terms of how it responds. The first is going to be a question of timing. The Israelis are likely to take a beat, not respond today, but perhaps to wait a little bit longer as they navigate through the different options. So that's kind of the first question, is timing. The second is one of covert or overt responses. Israel, of course, has extensive cyber technology that they can use to respond to the Iranians. The third is a question of whether or not they're going to directly respond to Iran or reduce the temperature to what had been happening before these missile strikes, which was engaging with proxies. And so it's a question of if they will, say, go after the Iranian nuclear program, which they might do over time or in different ways, or respond to other Iranian leaders as they're operating overseas.
I'm also interested, Carmiel, how you think October 7th, kind of the impact that had on the Israelis. I mean, they of course, saw 1,200 Israeli men, women, and children killed. What kind of impact do you think that had on the Israelis in terms of how they are thinking about geopolitical risk and threats?
Yeah, I think Israelis have felt vulnerable in a way that they had not felt really in decades. And we see that in Israel's response in Gaza, in suddenly realizing that perhaps the military wasn't as equipped to prevent or respond to attacks as many Israelis had really taken for granted that they could. What was quite remarkable about what happened over this past weekend is how effective not only the Israeli response was, but Israel's response in coalition with allies in preventing any of these Iranian missiles from causing any serious damage. There was, of course, one girl who was harmed and a few missiles that landed on the base that was the intended target, but there has been no significant damage to Israel. So I think in many ways what happened over the weekend restored some of Israelis' sense of security at home, but still underscores the need to really reassert itself as a powerful actor in the region.
Now, the main concern of the markets here in the United States, which is our usual primary focus, is that this does not, grow into a broader conflict in the region. So right now, given what we know at this moment, how do you sort of game that out? What is the likelihood that it will be contained?
Yeah, oil prices dropped slightly after these attacks, and I think that's in part due to the fact that the impact of the attacks had been so minor, really. But the prospect for retaliation remains very high. And that could, of course, have significant impact on oil prices moving forward, especially if this boils out into a large-scale conflict between the two. I would expect the temperature to continue to simmer and rise. So we've still not hit a boil over point of regional conflict, but what we've seen instead is kind of the slow increasing of temperatures, and I would expect that to continue.
And Carmiel, I'm just curious, what do we think, if at all, what kind of leverage Beijing has over Tehran? China buys a lot of oil from Iran.
Yeah, I think it's really important to pay attention to all of Iran's allies around the world, or those who are working with and supporting them, or vice versa. And that includes Russia, Beijing, and others. I think they do have an ability to influence the Iranians, but it's marginal insofar as Iranian ambitions for hegemony in the region remain completely unchecked. if not exacerbated by the war in Gaza. And so I think Iran is going to continue to listen to some of its friends, but ultimately is going to respond to what it believes is in its best interest as Israel responds to its attack.
Carmiel, thank you very much. Appreciate your insight.
Thanks for having me on.
Let's turn now to some calls of the day. We start with Astera Labs. Now, this is facing a fresh batch of Wall Street coverage after going public in mid-March. And a majority of the brokers that initiated coverage have struck a bullish stance on the stock, but the shares are down 1.5%. But let's put this in context here. This is a company that came public March 20th, a day before Reddit. We also got a lot of Reddit calls today. $36 a share. It was up 72% in that first day of trading, and it's continued to move higher. It is the best performing IPO, over $500 million so far this year. It is in the semiconductor connectivity business. And investors like that business right now.
Yeah, I mean, investors have been just so hungry to find ways to play AI, and they've decided this is one of them. Analysts seem to like it, Julie. I mean, 8 buys, 1 hold, no sell. Analysts at Needham saying, valuation looking pricey, but the company is among, they say, the fastest growers in the semiconductor industry. They talk about industry-leading margins. They expect estimates to go up from here, specifically from higher AI server shipments. Their target, 85.
Yeah, I thought also the one equal weight or hold equivalent rating is from Joseph Moore over at Morgan Stanley, who is definitely a veteran, experienced chip analyst. He says it's the highest growth company within his coverage, but it's got a high valuation to match that high growth. He said, though, that the stock will be a, quote, core small cap holding.
There you go.
Yeah.
Moving on, ServiceNow hit with a downgrade by Guggenheim Securities, taking the stock down to neutral from buy. Guggenheim citing a limited upside on this name. So that was the story. Guggenheim downgrades the name, officially go to the sidelines, Julie. The issue is valuation, it sounds like. It just looks relatively rich in their opinion. Stock has enjoyed a strong run, some about 60% in the past 12 months. And analysts saying there seems to be little upside potential for the year.
Yeah, and it's interesting. It's not just valuation because they get into some of their channel checks a little bit. ServiceNow has a big government business and a big commercial business. And the folks at Guggenheim said, well, before we thought the federal business was going to maybe cushion the commercial business. But they say now the macro backdrop isn't great, so the commercial business is still challenged. And in the words of the analyst there, even the Fed's coffers are not endless.
Yeah.
So that there's going to be pressure maybe on both sides of the company's business.
Company reports earnings on April 24th, so we'll get another read then. By the way, not where Guggenheim is at, by the way, not where most on the street are at. I mean, analysts are overwhelmingly still bullish on this name, but Guggenheim saying just kind of looking rich at these levels.
Yeah, definitely.
All right, we're just over 30 minutes away from the close, and stocks are at the lows of the day here. We're tracking all the action. It looks like the Dow's down about 270 points, S&P 500 down about 1%. The Nasdaq is down about 1.8%. It's the latest edition of our series Goodbye or Goodbye. We're going to get investors' insight on 2 stocks to help you make the best choices for your portfolio. That is coming up next.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal is to help cut through that noise to navigate the best moves for your portfolio. Today, we're looking under the hood of U.S. automakers amid a challenging EV market. So what's the best way to play it now? I'm here with BD8 Capital Partners CEO and Chief Investment Officer, Barbara Duran. Barbara, thanks for being here. Appreciate it.
Delighted.
So let's get to your buy stock, first of all, and it is Ford, which, as we know, has had a bit of a time, as have many of the automakers recently, but especially trying to get that balance right with EVs and other types of vehicles. So let's go through your bullish case here. First of all, you say the valuation's attractive here, and there actually are some catalysts that could help it going forward.
Yeah, there are. And if you look at Ford versus GM, it's really underperformed year to date and for the last year. Ford is up 3% year to date, GM 20%. For the last year, GM up 25% and Ford up 1%. And so there seems to be an opportunity here. I mean, it's trading in line with its historical valuation, which has been all over the place. But I think it's interesting here because it is a cyclical. And if you look where we are in the economy, you know, the economy is doing very well. And retail sales this morning were very strong. So I think it's a good point to be considering autos. And I think Ford over GM is an interesting one.
And just briefly, what are some of the catalysts that you're looking toward here?
Well, there's a number of catalysts because this has been an ongoing turnaround story. And they have done so many things. I mean, one of them, is just rationalizing their product lineup. They're really looking for which vehicles are the most profitable. And for them, that tends to be their pickup trucks, their SUVs. They've really scaled down on the cars. And so they're really looking at that and trying it even. We'll talk about the EVs, what they're doing there. And also just even in production, they're rationalizing their international. They've closed a plant in South America. That means the utilization in other plants is good. They're cutting staff. And they've hired 3 important new senior managers. One who was the Toyota North American marketing chief. And that's a big deal because they've done so well in the U.S. In fact, they're number 1 in EV sales. So that's a coup. And the other one is somebody to really oversee their dealer network worldwide, which is 10,000 dealers. So they're really going after every aspect of the business. And so there's just a number. And if you saw their quarterly numbers in February, they beat earnings and revenues. And part of that was cost cutting, but part of it's, the sales are doing well.
And then let's dig into a little bit more that sort of right sizing of the investment in electric vehicles and autonomous vehicles.
Yeah, because I think we now know it's stalled out worldwide in terms of what's happening, penetration of EVs. You've seen it in China, you've seen it here. In the U.S., at least for now, it seems to have stalled out for the whole U.S. market at about 7.5%. But what's really gone gangbusters this last year is hybrid sales, and you can go into the reasons why. I just bought a car and I did a gas guzzler because it's the charging stations issue. But anyway, hybrids are really hot. And so Ford has pulled back on their spending on EVs. They are delaying their EV rollouts a year or 2, and they are really focusing much more on hybrid. And what's that doing is freeing up a lot of capital, which is good for their cash flow. And with all the other cost-cutting initiatives, they're really, this fourth quarter beat may not be the last beat that we see.
And then finally, there's and you sort of alluded to this, but refresh vehicle lineup, that there'll be new cars for people to choose from.
Yeah, and that's a big deal because we're going to talk about Tesla next. And they have, whether it's they're doing their iconic cars, the Mustang. I mean, their number 1 selling vehicle in the U.S. is a Ford truck, a pickup truck. So they are coming out with just new things. They're looking at even simple things like what is not used in the car and getting rid of that and streamlining, getting their services and their tech, warranties, all that stuff so that it's really one package. So that's really important. So you're getting into a vehicle and you're feeling like, this is new, this is fun.
Right. And as always, we'd like to talk about what the potential risk is to the bull case. In this case, it's that we see a general downturn in spending on vehicles.
Yeah, I mean, that is clear. I mean, you're not going to get around the fact that Ford and GM, no matter what they do, are cyclical. So if you have a downturn in consumer spending, autos are where they're going to be hit. I mean, we had a lot to pent-up demand after COVID. Couldn't get parts, nobody could get cars. So and that's sort of normalizing, but that's always going to be the big risk.
Right. Do you have a position in Ford shares?
No, I do not.
Okay. Let's get to Tesla, which you alluded to. Obviously, it's been falling, right? It's down about 30% or so year to date. Here, we've got more competition in this space.
Yeah. No, this is, we talked a little bit about the EV market in general. And this is their only product. They don't have hybrids. They don't have anything else. And so when you see the whole market slow down, it's a question, what do they do? But the big concerning thing is that they're actually losing share. I mean, you'd think, okay, the total pie is expanding, but the pie is not expanding for now. So they're losing share both in China and in the U.S. And you've seen this through their price cuts. Right. In the U.S., if you look through the 18 months leading up to the end of the fourth quarter, calendar year last year, their prices are down on average almost 30%. That's huge. And when you see any car dealer or anybody having to cut prices like that to move it, it's not a good thing.
Right. And of course, now there's also talk about, are we going to get new models? Are we going to get refresh models?
That's a big problem.
Yeah.
I mean, they have no new products, and Elon just announced a few days ago that they are not going to do the low-cost model.
Well, he didn't say it. He said it wasn't necessarily true, right? It was Reuters that reported it, and he said that was a lie. And then he said, but we're gonna introduce the robotaxi, or we're gonna announce the robotaxi.
Right. Well, it's interesting because if they were not to do the low-cost model, the luxury segment, that's another part of the EV story, is pretty saturated right now. So you need to lower the cost. So I don't think he can afford to take that off the table. Mm-hmm. But the robo-taxis I do not see as the end-all and be-all, because if you look at the market right now, I mean, self-driving cars, they're only legal in 3 states. They are only being tested in 6 cities around the world, 2 in China, 4 here. And you've got so many engineering problems. I mean, 8 years ago, Musk said, we're going to roll out. You had Apple, after 10 years and billions of dollars and 5,000 people on the case, fold their effort. Engineering is very tough, and they'll probably be higher cost because of these sensors and cameras and all that stuff in terms of the technology. So I think that the market could develop. It could be that, in 5-10 years, we're saying, wow, let's get in our, a robo-taxi. But there's a lot of issues, not least regulatory and moral. Some people have a real problem with it.
Well, let's get finally to how this thing is priced, right? Because the valuation is effectively, if you look at this versus a GM or Ford, and it's always been this way, it's valued more like a tech stock than like an auto stock.
Yes, it is. And I don't agree with that. I never have. And if you look at it right now, 62 times versus GM is 4.5, Ford is 6.6. If you even put a 10p on the stock, it would be in a $20, $25 stock. So I think the stock will just continue to come down because it's hard to see what's going to turn it around. Maybe the robo-taxis in 5 years, but I don't see a near-term catalyst for them.
And just like we talked about the downside, the down risk for the bull case, the up risk, I guess, for this is that he does come out with the robo-taxi by the end of the year, and it does great.
Yeah, it does great. But you know what? They had a recall of 2 million cars that had autopilot just in December because the autopilot wasn't working properly. It wasn't doing at least the regulators felt it wasn't having the proper alerts to say, hey, you're falling asleep at the wheel. So I think, that is the risk. And if it does take off, it can save the company, but it would have to take off and you'd have to I don't see it. They haven't even made their applications in California yet.
All right, Barbara, thank you so much. Really interesting stuff on Ford and Tesla. And just to recap what you're telling people, tell investors to buy Ford amid that attractive valuation, moving past peak spending on EVs and AVs and that refreshed vehicle lineup. On the other side, you say avoid Tesla. We've got a high valuation. We've got an aging lineup of vehicles, and there is more competition in EVs. Thank you so much. Really appreciate your time.
Thank you.
And thank you for watching Goodbye or Goodbye. We'll be bringing you 3 new episodes 3 times a week at 3:30 p.m. Eastern.
Time now for the day's trending tickers as we approach the closing bell here on Wall Street. Taking a look at shares of Salesforce, company reportedly in advanced talks to acquire Informatica. It's according to the Wall Street Journal. Shares are sliding in today's trade. CEO Mark Benioff, we know he likes to do big deals. Slack, MuleSoft, Tableau, now could be ready to do another one. Bloomberg saying Salesforce is pursuing Informatica. Point would be to add CRM's data integration and management capabilities. Deal could happen within a week potentially. Benioff, remember, he had his hands full with activists. He actually avoided a potential proxy fight with Elliott last year, got religion, Julie, on cutting costs and boosting profitability, and now maybe ready to pull the trigger again on a pretty meaty acquisition.
Yeah, so a couple things on this. First of all, the Journal, which originally reported that these two were in talks, had said that the deal price was around $38.48. The shares actually of Informatica actually closed on Friday above that level. So the question was, could Benioff convince them to take less than that Friday high close for the stock? So that's one fly in the ointment. The second is, like you said, he just finished this big proxy battle and big activist battle with a bunch of different high-powered activists who said, we don't want you to do as much M&A. he solved that and he's like, well, can I just sneak in this $11
What about
billion
one last
acquisition?
check?
I mean, what? It's sort of confounding. And it looks like that investors are confounded as well. And that's why the shares are trading down.
Yeah, on the actual strategies, this is RBC's Rishi Jaluria, who we know, Julie, he kind of weighed in here too. He was saying to his clients somewhere, he's just kind of mixed on the news. We recognize, he said, listen, on the one hand, Salesforce can easily make an argument about data integration and bringing together Informatica, MuleSoft, Tableau. We recognize the difficulty of integrating all these services, he says, and question the necessity of Salesforce owning Informatica versus simply partnering. So lots of questions on the street as well.
Yeah, seems like he's not alone. Let's talk Charles Schwab as well. The company missing estimates for total net new assets in the first quarter, but the brokerage expecting its net interest margin to expand through 2024. That also really stands out in particular because a number of the big banks did not necessarily raise their forecasts for net interest margin or net interest income here. So interesting that Schwab is doing that. And the company is saying that they are seeing solid investor engagement as well that contributed to 1 million new brokerage account openings in the quarter.
Yeah, also plan to resume stock repurchases as they say temporary headwinds continue to subside. CFO saying capital return is a very, very important part of our financial formula.
Yeah, so that doesn't hurt when it comes to the stock going up today either.
All right, moving on. Goldman Sachs reporting earnings this morning as we're in the thick of earnings season now for banks. Our next guest calling Goldman's first quarter results its cleanest quarter in a while. For more on the banking sector, bringing in Barclays senior equity analyst Jason Goldberg. Jason, it's good to see you. So Goldman reports investors like what they see. The stock is up about 3% on a down day. But give us your high-level thoughts, Jason. What did you make of the results?
Yeah, no, certainly. As you said, Goldman had its cleanest quarter in a while. I think it spent much of last year kind of narrowing its ambitions in the consumer space, and that resulted in a fair amount of charges, as well as it kind of reshifted its balance sheet and built capital. And you also had very subdued investment banking activity last year. You turn to the first quarter this year, you did see a pickup in investment banking activity, albeit still below historical levels, but much improved. They posted pretty impressive trading results, particularly relative to what we saw last week out of JP Morgan and Citigroup. And we didn't have, these kind of nagging charges that weighed on results most of last year. So, here's a company that, put up a, mid-teens ROTCE after putting up kind of a single-digit ROTCE last year. So off to a good start.
So this is a very different story than the narrative around Goldman Sachs last year, right? To your point, the numbers were different, but also the sort of vibe. David Solomon was sort of getting a lot of criticism. Execution-wise, what has changed at Goldman? I mean, some of what you're talking about is just lapping bad comps, but what have they really done that you think has been the pivot here in getting to this better performance?
Yeah, no, certainly. I think, in 2001, 2002, they spent a lot of time, energy, and money kind of building out, a mass market type consumer franchise, both lending and even wealth management, and spent much of last year kind of downsizing that. So downsizing what they're doing in the credit card space, selling off their Green Sky unsecured consumer lending platform, selling off their personal financial management unit that they acquired not that long ago. And, to do that, they certainly took on some charges and costs associated with that. And finally, as you start to see the results this year, you don't have the drags from those businesses and just the cost to exit those businesses weighing on the results. And on top of that, you did see a strong trading quarter. And, finally, after, really 2 years of subdued investment banking activity, signs of life in both underwriting and M&A.
And Jason, I'm just curious to get your take on kind of the job you think CEO David Solomon has done here. I mean, to Julie's point, last year was rough. He caught a lot of heat, criticism for the consumer business. You know the firm so well, Jason. What grade would you give him?
Listen, I think they took a chance on the consumer strategy. It didn't work. They quickly pivoted away from that. So it's hard to sometimes fault management for trying strategies to grow. I think sometimes companies don't try to find enough ways to grow. I'll give them, it didn't work, and I'll give them credit for, quickly pivoting, cutting their losses, acknowledging, they try to do too much too quickly, and kind of refocusing the franchise back to the core strengths in terms of investment banking, and trading. And now with kind of a renewed emphasis of kind of merging their asset and wealth management businesses together, you're starting to see the fruits of that labor come together. And you're seeing a pickup in both, record assets under supervision this quarter, as well as kind of reducing the capital intensity of that business.
Jason, I want to broaden out, if we could, and talk about the other banks that we've heard from thus far, because I am not a TikTok user, but clearly you're more up on your TikTok trends than I, because you wrote your latest note reacting to the bank earnings, sort of a riff on no Chick-fil-A sauce, which I guess is a thing. The disappointment that investors felt in not getting that net interest income forecast increase from a lot of the big banks. Why do you think they didn't get it? And do you think that the banks are going to kind of muddle along as a result?
Yeah, certainly that was a theme on Friday, I think, with JP Morgan, Wells Fargo in particular, and also Citi not increasing that interest income guidance, something that investors were looking for. State Street did. If fast forward to today, M&T actually did. And we still have a lot more banks to come out this week. I think a lot of it's just driven by banks taking some, a cautious approach. Loan growth is off to a slow start this year. That tends to be a big driver of net interest income. And while deposit trends year to date have been good, I think there is just some uncertainty, particularly given, at one point we thought that was going to cut 6 times this year. Now the market's thinking 2 to 3 times. And ultimately how deposits behave against this kind of changing backdrop, I think gives management a little bit of pause for not wanting to increase their net interest income guidance after, them kind of having to lower guidance throughout the course of last year, just given, some of the issues that banks had around deposit pricing.
And Jason, Morgan Stanley reports tomorrow. You're a fan, overweight the name. What do you expect to hear?
Yeah, no, certainly. I think you'll see, like you saw at some other banks, pretty strong results in investment banking fees. So you should have a pretty strong quarter there. Much more strength in fixed income underwriting. Less of an increase in equity underwriting, and maybe a further decline in advisory. Although we do think pipelines are good there. They should have a sound result in trading. They're more geared to equities. Equities is kind of running up year over year, despite the fact you had tough comps a year ago. And, both their wealth management and investment management businesses should benefit from the market lift. And I think importantly for them, net interest income was a headwind for them last year in the wealth management unit. We do foresee signs of stabilization in the first quarter of this year. So, we think they'll, put up pretty sound results.
And Jason, maybe this is a little unfair because we haven't heard from them and we're not entirely through the season yet, but what's your top pick within the space right now?
Yeah, no, I think generally speaking, certainly have a bias towards the bigger banks. We've talked about, improvement we're seeing on the capital markets front. We haven't gotten into credit quality yet. We'll hear more about that as this week goes on from some of the regionals. But while this first quarter feels okay, we do see loan losses materializing throughout the year progresses, more so in the regional banks, given their commercial real estate concentrations. So maybe a little bit more cautious there. But despite the sell-off on Friday, still feel very comfortable with names like, at JP Morgan. We're looking forward to Bank of America results, which also reports tomorrow.
And so are we. Jason Goldberg, thanks a lot. Good to see you.
Thank you.
Well, as fears grow of an escalating conflict in the Middle East, we're taking a closer look at the potential volatility next in our investor playbook.
Israeli officials are weighing a response to Iran's attack over the weekend, fueling fears of a widening Middle East conflict. We're looking at how to navigate the big picture with the Yahoo Finance Playbook. We're joined now by Jay Woods, Freedom Capital Markets Chief Global Strategist, and Adam Johnson, Portfolio Manager of the Bullseye Brief American Ingenuity Fund. Guys, great to both have you on the show. Adam, I'll start with you. So. Sure. Obviously, listen, geopolitics front and center.
Yeah.
Iran, Iraq. I'm sorry, Iran, Israel, China, Taiwan, Russia, Ukraine.
Take
right?
your pick.
When you're talking to clients and they're asking you how to navigate all this, what are you telling them?
Eye on the ball, play through the pain. This is not what drives markets. And I tell you why I say that. It almost sounds callous for me to just make that my volley right off the bat. But if you go back and look at the 20 or 25 different events, geopolitical events, that involved hostilities, Gulf War I, Gulf War II, the bombing of the USS Cole, the World Trade Center, on and on. You look at all these events, and typically what has happened is that you get a 7 or 8% sell-off in the first 5 days. There's a bottoming, and then 10 days later, the markets are exactly where they were. So it's an emotional response, which is an understandable response, because it's upsetting to see these images, and yet we get through it. And that's why I say it sounds callous of me to say play through the pain, but honestly, that's what history has taught us. You play through the pain. If you're picking high-quality companies and focused on earnings, and by the way, not interest rates, because we're so sick and tired of that whole debate, then that's ultimately what matters, and that's what will win the day. It's time in the market, not timing the market.
Yeah, I mean, this is something, listen, all of us around the table have been watching markets for a long time. Even Russia-Ukraine, which is a conflict that is still happening. And you still do get, like today, there are new sanctions related to the metals. You've got some action in the metals. But in terms of equities, how do you look? Do you view this similarly to how Adam's looking at it?
Well, I think you look at the events and you're going to see reactions to them. That's what we're seeing now. We saw it on Friday in anticipation of exactly what was going to happen. But something's different this time. And, you know, we've had 1% corrections intraday in the S&P 500 this year. Nothing crazy. Each time until today, we've rallied back. Today was different. We got that morning rally, and now it's reversing. A lot of it has to do with retail sales. Inflationary numbers keep acting, that hot CPI number. It has us on our toes, and interest rates, the 10-year, that's what drove the bust last year. And then when we were at 3.75, where was the S&P 500? It was under 4,500. We've rallied in tandem. Now we're starting to see that separation. I went back and looked. The 10-year, when it went above 4.6 for the first time last October, November, the S&P corrected 10% during that time. So now we're seeing what I think is a normal correction, and we have this backdrop to give it more of a narrative.
And just quickly then, do you buy into that correction then, or do you sort of wait until stocks maybe drop further?
I think we could drop a little further, but I think this is a Bible dip. We've seen strong earnings. The financials came out with great earnings. JP Morgan earnings were nothing to sneeze at. I know Jamie Dimon, he's typical little, skittish with his outlook, geopolitical headwinds. Yes. Goldman Sachs knocked it out of the park. Citi, Wells Fargo did well. But we've come so far so fast. I don't see that next catalyst outside of individual pockets of earnings to take the market higher. And now with the rising yields again going towards 5%, I don't think we get there. That broadening rally in the small caps, utilities, that story is over for now. And yeah, I think we pull back, but I think this pullback should be bought.
And so Jay brings up the 10-year, and you are back at the 4.6.
Yeah.
You think climbing closer to that October high 5%, do you think we test 5%?
I sure hope not.
If so, what does that mean for the market?
Yeah, I hope we don't test that 5%. But markets are wrestling with the fact that we may not get as many rate cuts as let's rephrase that. We won't get as many rate cuts as we thought. A few months ago, the assumption was we'd have 3 by June and 3 more by December, and now it's basically 1 and 1. And I think 1 and 1 is reasonable. Inflation went up to 9.1%. Consumer Price Index, that measure of inflation, went up to 9.1. PPI went to 11.2. And now PPI is 2.2. The PCE, personal consumption expenditure, is what the Fed looks at, is at 2.5. GDP Price Index is down at 1.6. And actually, it's really only the CPI that's still above 3. And if you average all 4 of those together, which I know is, a true blue economist would tell me that's not fair. But it's my back of the envelope. If you average all 4 together, you get to 2.4%. The Fed's target is 2. So I think we're getting to the point where inflation is starting or will will start to become a rear view mirror indicator. We're not there yet. The market's wrestling with that. I think earnings matter more, and as this earnings season begins, that's where my focus is. Admittedly, it's not on what's happening in Israel, and it's honestly not even what's happening at the Federal Reserve. It's what's happening in corporate America.
Yeah, so I'm getting the vibe from you guys. So Jay, a little bit more macro focus on the day-to-day. I know you tend to really dig into the fundamentals of specific companies. So Jay, before we, and I do want to get some stock picks from you, before we do that, Jay, are there sort of asset class wise, are you looking at to add oil, for example, here? Like what, in these sort of volatile times when people are watching Geopol a little bit, where do you go?
Well, I think technology, the stocks that led us back in 2023, the NVIDIAs, the Metas, the Amazons of the world, I think these pullbacks, if we get them, they're not dramatic, but we saw that was kind of a safe haven trade, which was weird last week. I think those earnings, those are the earnings stories that you want to follow. Technically, they look fantastic. Amazon just breaking out to all-time highs. So I still think the big name, big cap stocks are fantastic. But those small cap companies that depend more on the yields being a little lower, the higher for longer narrative is going to leave them in the dust just for, at least 3 to 6 months for now.
And Adam, so Jay's mentioning tech.
Yeah.
You got some tech names, like including NVIDIA still.
Oh, yeah. Oh, yeah, I can give you plenty of names. NVIDIA, I've loved it for a long time.
How come, Adam?
Well, because they have the fastest chips in the world. 40, let me say if I can say it right, 40 quadrillion calculations per second. All right, that's 30 times faster than any other chip out there. And by the way, these new chips that are so fast consume 4% of the power of the old chips. So they're very efficient, which is obviously important. This is the key to artificial intelligence. The stock is trading at about 30 times forward earnings. That's cheap. When you're growing your earnings at 75, 80, 90%, to pay 30 times earnings, to me, that's cheap. I bought NVIDIA. I flagged it for my subscribers, bought it for my money management clients at 175 about 2 years ago. My first target was 475. We sold a little. Next target, 675. We sold a little. 900. We sold a little. My next target's 1200. And I think that's the way to do it. As these stocks go up that much, they get bigger, and you have to sell a little. Otherwise, they're too much part of the portfolio. So yeah, tech's in there in a big way.
Do you ever get nervous when when you're in NVIDIA? Do you get nervous when everybody seems to be on the same side of the boat?
Yes and no. If I'm confident in the fundamentals, and I think that I have the story right, and I think I do on NVIDIA, then I'm happy to see other people with me. But I was buying NVIDIA before other people got in, and that's interesting because, Facebook, I was buying from 150 down to 82, and I would get calls from clients and say, why are you still buying this thing? And I said, well, if they just stop spending on this thing called the metaverse, actually it won't be trading at 16 times, it'll be trading at 8 times. Unfortunately, Zuckerberg got the memo, stopped spending, and that's now a $500 stock. And as people started to shift their view on it, then they joined me, and that inflow of money is what pushed the stock up. So to answer your question, I like seeing people with me. I'm also okay being a little early because then I'm positioned, and when people do come to my side and they start buying it, that helps.
So Jay, specific wise, you mentioned some of the big cap tech. What are you really excited about right now?
I'm still trying to figure out how many zeros in quadrillion. That was some number there. Besides technology, I look for consumer discretionary stocks to pull back and to be good opportunities. I don't know, I would go in the Tesla camp, but
Agreed.
Yeah.
Agreed. I won't touch Tesla. I never have.
All right. You see, we're on the same side. Yep. We're supposed to be on the other side.
No, you don't have to argue. That's not what this is about. You guys are allowed to agree.
No. I think these points are fantastic. I think semiconductors have been topping a little bit, and we're getting opportunities in some of those strong sectors to put money to work. So I don't think we're through this storm cloud, and it could accelerate if these headlines get any louder. But I'm watching specific earnings like Procter & Gamble next week. The 14% of the XLP, the staple index, that's a big one. I think that's this Thursday. UNH, which was the biggest Dow stock. I don't know how it ranks right now. Microsoft is catching it. But healthcare has been under pressure. Let's see what they say going forward. So healthcare has been beaten down. I still think there are pockets within healthcare, especially elderly care, where there are strong plays. So I'm I hate to be the stock picker's market guy, but there are pockets within each sector that should weather these storms and be positioned to be bought.
But honestly, actually, that's how you beat the market, what you just said, right?
Exactly.
It's being a stock picker. It's finding the unique opportunities that set you apart from the S&P 500.
He's a stock picker, so he'll always say it's a stock picker's
I will always
market.
talk my book, because I'm not going to talk anybody else's, okay?
That makes sense.
Adam Johnson, Jay, thank you guys both so much for joining us. Appreciate it. While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for market domination overtime.
There's the closing bell on Wall Street, and now it is market domination overtime. We're getting you up to speed on the action from today's session. Let's start with the major averages here. So we've got the Dow down about 0.5%, near the lows of the session. We were on watch here to see if it was still going to stay in the green for the year to date, and for now it has, by not by much, only up about 0.1% for 2024 as of right now. The S&P 500 down 1.2% on the session, and the Nasdaq down 1.8% on the session. Now, we've been talking about the catalysts that have been driving stocks lower. A lot of it had to do with headlines around Israel that came out sort of early afternoon that sent stocks to their lows of the day, raising concerns about a widening of the conflict in the region. But even before that, we were looking at a hot retail sales number that drove yields up. And so that's something also putting pressure on stocks. Now, as we look at the sectors here, a pretty broad-based sell-off that we saw, with tech leading the declines. The XLK, that is the tech sector ETF. Real estate as well, though, also declining because of that increase in yields. Then we've got consumer discretionary and communication services. So big sell-off there. Quickly, just to look at some of the losers in the Nasdaq 100 today. All of the so-called one-time Magnificent Sevens are down, with Tesla, as we've been talking about, down sharply, in particular on the news not only of layoffs, but also of the departure of two key executives from the company. That was unexpected by the street. The shares down 5.5%, Josh.
A wild day for investors on Wall Street. The Dow sliding 200 points on the day. It's after being up 400 points at the high earlier in today's trade. Joining us now for the day's trading takeaways, Josh Schaefer is here with the latest.
Yeah, Josh, Julie was just pointing it out, but I think we saw a clear trend today that markets are going to care as we get more headlines on potential escalation of the geopolitical conflicts we're seeing in the Middle East. You could see it exactly where Julie was circling on some of those S&P 500 intraday charts, the Dow intraday charts. That's where we started headed lower. That seemed to be what investors were watching today. It was actually interesting because it seemed like coming out of the weekend, when we, of course, had a lot of headlines, that stocks were okay with it, right? And the market was generally okay with sort of where things landed. Then throughout the day, as we learned more about what could be developing and potentially more conflict, right? It seemed that all of a sudden we cared a little bit more because it seemed like the conflict could get worse. But it was just interesting, I thought, because I sort of expected to wake up today and maybe see futures down after the weekend, and we didn't quite get that. So it seems like maybe we're getting to a point where we're a little bit more uncomfortable.
Well, it was also interesting because we didn't even see stocks start to take a hit after the retail sales report and the surge in yields. I mean, yields were up 12, 13 basis points for most of the day.
Like 8:30. Yeah.
And it didn't seem to hit stocks until we then got that Israel headline. It was almost like there was a sort of delicacy of the rally that then crumbled once we got that headline, which just shows like the underlying volatility, which I know is one of your takeaways from today.
Yeah,
too.
and it just seems like people are looking, we've been talking about this for a while now, but looking for maybe some reason to take some risk off the table here. And maybe it's more about that than it is about sort of what the actual meat is within the conflict that we're seeing, I think. Because I've been listening to strategists you guys have had on this afternoon, people that were speaking on our show in the morning. And it doesn't seem like we're at a point yet in this conflict where people are specifically concerned necessarily about the conflict itself and sort of the escalation. It seems a little bit more, maybe investors have been looking for a reason to sell in the start of a conflict. Could be that. But yes, Julie, I did want to talk about volatility because I know we talked about the VIX a couple weeks ago and you were not satisfied with the move higher.
Was not impressed.
Today we hit a 6-month high in the VIX. It's above 19.
Go back to chart, Julie.
I think it's above 19 now, which is about the historical average. So we're increasing rather significantly, but I do give you it is not that high. So I guess, do you care?
Yeah. Get the Julie Hyman take.
We'll see how long it's. I mean, by definition, usually you get a shock to volatility. It hits that and then sort of comes back down. But we'll see what happens. I don't know.
We were talking to Tom Sosnoff on Friday, and he did think, like, listen, when the VIX, the move in the VIX, Sosnoff was like, you pay attention to a move like that.
Well, because one takeaway that I had looking at the VIX chart, at least over the last 6 months, and the S&P 500, you're looking at it here, we just haven't really had any volatility within that volatility measure, right? And I think that's maybe the feature to take away from the last 6 months of the rally, is it's not like we've been fighting something like the VIX on the way up. So it sort of makes sense that as it does start to at least come back into play, I mean, it's been asleep for 6 months. So it makes sense that people are starting to take some level of note of it because it basically has been a non-factor. So it's, I guess, maybe one of the things that we can put in the several other worries that are starting to build here. Like maybe, was the retail sales print too hot? I don't know.
But I guess one of the worries was not that consumers aren't spending.
Right. I think, I mean, I don't know. I often come on here and I'm in the good economic news is good news camp, and I'm not really planning to leave that camp. But I think that was one of the takeaways would be, well, if we're going to have higher rates for longer, I think people would be more concerned if retail sales just fell off a cliff than if they continue to come in hot. Not necessarily shockingly hot, though. I mean, if you look within the print, it's not like you had a crazy amount of breadth there in spending. A lot of people bought stuff online, and it gave you a big increase in retail sales. It wasn't a massive report where everything is going up and you're wondering what's going on. So it will be interesting to see how we continue to react to these reports right now, because I think we're still in a phase where economists want to see the consumer doing well, especially when we're thinking about having more restrictive policy for a longer period of time. You want that consumer to hold up. If the consumer doesn't hold up, all of these stocks that people own in that overall economy, they're not going to be buying things, and that's not going to be good.
Right. Yeah. To put it simply. Thanks, Josh. Appreciate it. Well, let's check on one stock that has been of high interest, not just today, but over the past several weeks. We're talking about Trump Media and Technology Group, or DJT, as it's known for the ticker. This company plunging after it filed to issue millions in additional shares of the stock. And by the way, the move coming as the jury selection for Donald Trump's upcoming criminal trial over allegations of hush money payments is now it's going on. They're doing jury selection, which is seems like a bit of a slog in reading some of the updates here today. So they're going through that, and Trump has been required to be present for most of the processes of the trial. So that's sort of the backdrop here. As we know, a lot of the people who have been buying shares of this stock have been supporters of the former president and did it in part because they wanted to continue to support him.
Yeah, it's interesting. So the filing was, it sounds like, Julie, to issue new shares. It includes, from what I was reading, the potential sale of up to about 115 million shares held by the former president. Next steps, it looks like Trump Media needs the SEC to review all this paperwork, give the official feedback. Of course, listen, very rocky road for the stock. Bloomberg actually saying the paper windfall for former President Trump has now dropped. It was $5 billion at one point. Now it's more like $2 billion. Still not shabby, but a very steep drop.
Yeah, I mean, the stock was, a high of 66.22. That's where it closed on March 27th. And now you've got it trading at close today at 26.61, it looks like. So obviously a big haircut from the highs. And we don't know how many retail investors bought at the highs. The company itself has trumpeted the number of retail
So to your point,
investors
people
who have
piled
bought into
in to show their support for Trump and for his reelection. And it did soar in the lead up to the public debut, but to your point now is really nice, nosedived.
Yes, it has. All right, stick around. We've got more market domination overtime coming right up.
Over the weekend, Iran launched its first ever direct attack on Israel with a salvo of hundreds of drones and missiles. David Blumberg is currently in Israel, where his venture capital firm, Blumberg Capital, has offices and investments. David joins us now for more on the state of the Israeli economy and tech community. David, it is great to see you and have you on the show.
Thank you so much, Josh. Great to see you as always.
So, David, you're in Israel now. You were obviously there over the weekend during this Iranian attack. So, David, I just first want to know how you're doing.
You can see I'm fine. I'm happy. I feel safe. I feel with my team here on the ground. We had a meeting with about 20 of our portfolio companies last night. We did it by Zoom instead of in meeting. But people are very resilient here. The streets, you can't see them. They're full of people. At restaurants, the clubs are busy. Traffic jams happening. It's remarkable how normal it is in a time when I think in America or other places, if this happened, people would be really freaking out. Israelis are unfortunately somewhat used to these kinds of things. This is the most severe it's ever been. But they really did a great job with the Americans, the British, and the Jordanians and French to knock down 99.9% of all the projectiles. So I think people feel like they won this battle.
And so, David, the Israeli people, a resilient community. At the same time, David, they are engaged in this three-front war. It's Iran, it's Hamas to the south, it's Hezbollah to the north. It's an enormous economic burden for the country, David. You just think of soldiers being called up and the tens of thousands of Israelis displaced in the north because of Hezbollah. How does the economy sustain this, David?
Well, I like to always look for history, Josh. So as we recall, over the last 25 years, there have been 4 or 5 war conflict situations, plus COVID, plus the dot-com crash, plus a number of other financial crises, et cetera. So if we look at that, we see that over those 25 years, the Israeli GDP per capita, measure of productivity of every individual working, grew 2 to 3% faster than OECD countries during that same period, pretty consistently. Now, there were downturns, and then they've come back. But over time, you see this growth. And in fact, I was looking at the data recently. In 2023, Israel achieved a GDP per capita of $54,000. Now that is higher than France, higher than the UK, and higher than Japan, which surprised me to see that growth. Because Israel, when I first started coming here, was a much poorer country. But the tech boom in particular has really bolstered the economy. And as you're asking, it seems to thrive despite and through downturns. There are downturns here, but the next year they get stronger.
Are you confident, David, when this war ends, whenever that may be, that the Israeli tech community emerges as strongly as ever, that it remains a true global tech powerhouse?
Absolutely. Israel currently is the #1 recipient of, #1 for startups per capita. Their society is very startup oriented. I met dozens of young entrepreneurs who right now in the middle of this situation are pitching me plans and wanting to grow. It's also #2 in terms of investment in R&D as a percentage of the GDP. It's #4 in companies listed on Nasdaq. This is all developed over the last 25, 30 years. It's not stopping. Why? Because Israel has, in my opinion, the requisite skills for the 21st century, high technical talent, training with this military experience that gives them solidarity with their teammates, trust to take on a new adventure, and experience training for software development in very important fields such as artificial intelligence.
Your firm, David, Blumberg Capital, it has offices in Israel. What happens to a VC firm, David, during a hot war like this? I mean, are your colleagues there? Are they able to, meet founders, write checks? Is anybody doing deals, David, or is that kind of put on hold for now?
We were meeting companies here all the past 2 weeks. We spoke at a university, had 25 students asking us Q&A questions about their future careers. We saw, now not in the venture world, but Intel just a few months ago announced a $25 billion investment in a new fab. And they're learning from the past too, because in history, when the Gulf War started, Intel kept their people producing 24/7 throughout that war, and I think they're proud that they've never missed a day of production, or maybe one out of 25 years. So they've developed a way of coping with what might seem in a normal civilian life as a very difficult situation. But humans are very adaptable, and if they have to succeed because their lives depend on it and their livelihoods depend on it, they find a way forward. So I think Israel will come through this like they've come through 5 or 6 previous crises, stronger than before, battle tested. Their customers will say, wow, they innovated on the battlefield. If they're buying defense equipment, they will say, wow, they kept delivering to us like Intel, the chips or software producers. And also, I would say that the reserve demands for the Israeli military is generally about 15% maximum at any time. So when our companies had their people called up, there was a period of a month or two where they had maybe 10 to 15% of their staff on the front lines or in support roles. But most of them are back now. There'll be another reserve call-up, it looks like, after this Iranian attack. But again, they get through it. Most of these companies are multinational from birth. Engineering is in Israel, but all the sales, marketing, and finance functions are often abroad, in the US chiefly, sometimes in Europe. And so those colleagues in the outer diaspora world pitch in and support as well.
David, it was great to see you, my friend. Stay safe, and we'll talk soon.
Thank you very much, Josh. Good to see you.
Time now for What to Watch. Tuesday, April 16th. Let's take a look at earnings first of all. United Health Group to report first quarter results before the opening bell. Investors are keeping an eye out for the financial impact stemming from that cyber attack in February on its Change Healthcare subsidiary. Also within the healthcare space, we've got Johnson & Johnson set to report its first quarter numbers. Meanwhile, for financials, Bank of America, Morgan Stanley, BNY Mellon, and PNC all reporting earnings ahead of the market open as well.
And turning to after the closing bell, United Airlines deliver first quarter financial results, commentary on FAA investigations, the fallout from troubles with Boeing jetliners to be a point of focus for investors. Report coming after competitor Delta posted strong quarterly results and upbeat guidance. Investors can also expect results from J.B. Hunt Transport and Interactive Brokers after the market close.
And meanwhile, on the economic front, the U.S. Census Bureau releasing a new batch of data on the housing market. We've got building permits and housing starts for the month of March expected to fall compared to February. That's a month where residential starts saw a rebound after weather-related weakness.
And coming up, Netflix set to report their first quarter earnings on Thursday. We're joined by an analyst on the other side to break down what to expect from the streaming giant. Stay tuned. More market domination when we return. Earnings season is here, and this week we're getting the latest numbers from Netflix. Streaming giant expected to announce quarterly results Thursday after the close. And to get you ready for those results, Alicia Reese, Wedbush Securities Vice President of Equity Research, joins us now. Alicia, it is good to have you on the show. So you look at this stock, Alicia, what a move. It's up about 25% already just this year. It's up about 80% over the past 12 months. What explains that move, Alicia? Why all the enthusiasm?
Right. So Netflix put in place quite a few initiatives over the last year that drove the share price quite a bit higher, as you mentioned. One of those was the password sharing crackdown, and that did two things. One, it knocked off all of the people who had been sharing, who then had two choices. The account holder could either add them for an additional fee, that's the extra member fee, and then those who got kicked off the accounts could opt for their own subscription or stay off for a time. Many of those have gone on to get their own subscriptions. And so that helped on both the subscriber growth front and also the average revenue per user front. At the same time, Netflix implemented its advertising tier, and that's at a lower price. So that really enticed quite a few of those members who were, or not members, the sharers who were kicked off the shared accounts to take their own account for quite a low price. That offset some of the gains on the average revenue per user, as that was dilutive for a long time, but we're now starting to approach parity. And over the balance of the year, I think we'll reach accretion, and throughout 2025, I think that accretion will expand.
So Alicia, if I'm understanding you, so the ad tier subscriber and the premium subscriber, which one of them is going to end up being more valuable in the end?
In the end, the ad tier. At the moment, it's still the premium tier. And the survey work that we do intra-quarter still shows extreme stickiness on the premium tiers. But for the new, for members or potential subscribers, people who are coming in who were not subscribers before or who are returning subscribers, are more inclined to opt for the ad tier. And currently, the ad tier is still slightly dilutive. I think it's reaching accretion soon. It'll be, at parity with the premium tiers, the average premium tiers. But until it does so, that's going to, draw the ARPU down a little bit. That extra member feature that is, Netflix is still benefiting from, and also selective price increases have kept that ARPU relatively elevated. But once we really start seeing that viewership rise on the ad tier, more and more members on the ad tier, more advertisers will flock to the service, and that will become significantly more accretive to Netflix than its premium tiers.
Alicia, let's talk professional wrestling. So Netflix is going to be streaming WWE's Raw next year. Do you see them kind of just moving harder into live sports, Alicia? I mean, they got the cash to do so, and live sports means plenty of eyeballs.
Yeah, I think they're being really careful with that. I think WWE is a really smart move to start with. It's, like they say, the drama of sports that they want to lean into. And I think it's really a testing ground because they don't have a very robust ad platform as it stands. They need to build that out. They need to continue building that out. So far, that's gone very well for them, but they still have quite a ways to go. So what they can do with the WWE is advertise not just on their advertising tier, but to their premium members as well on some of those live, the live shows. They also have a lot of shoulder programming where they don't necessarily need to advertise on the premium tier, but they can on their advertising tier. So as they really build that out and make that more robust over time, I certainly think they'll lean into more sports content. And meanwhile, they have more gaming content that they can lean into with advertising as well.
So a lot of the catalysts we've been talking about are a little bit longer term. Let's talk super short term and talk about the earnings that are coming. You're in an outperform. Would you add to holdings of Netflix going into the numbers, and do you think they're going to beat and that'll be a catalyst for the stock?
I do think they'll beat. I think they'll be able to hit the subscriber numbers that the street is calling for at about, I think it was 4.8 million the last I checked. I think Netflix can handily beat that. I think the average revenue per user, like I said, is still seeking parity, with the premium tier. So I don't see a huge benefit in Q1 on the ARPU, but I think with between that being similar to Q4 And then having more subscribers should certainly get them to and above their revenue targets. And I think that free cash flow growth, particularly as they have not had to materially expand their content spend over the last quarter because they're really leaning into more licensed content and not quite as much original content, that should really help drive earnings beat and free cash flow expansion.
And we're waiting for those numbers after the close on Thursday. Alicia, thank you so much. Appreciate it.
Thanks for having me.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow for all of your coverage leading up to and after the closing bell. Stay tuned. We've got more Yahoo Finance on the other side. Bitcoin drifting lower today after a steep weekend sell-off following Iran's attack against Israel. Joining us now, Jason Less, CEO of Riot Platforms, which is a Bitcoin mining company. And I know all of the talk in the Bitcoin mining world has been about the upcoming halving, but I do want to ask you first about price, Jason, and kind of what you're expecting here in the coming week. It's a little bit difficult to predict these days how Bitcoin is going to react to geopolitical events.
Yeah, it is difficult. And I would even remove the second part of there. It's always difficult to predict how the price of Bitcoin will react. I think the fact is there's lots of trading and fast money in and out of Bitcoin all the time. And geopolitical events like what we witnessed over the weekend can cause a lot of short-term volatility. If you zoom out and look at Bitcoin over the long term, though, there's a very positive trajectory in the price upwards and to the right, and that's because Bitcoin is sound money. Bitcoin has a fixed supply, and that is attractive to investors. And the halving that we're going to experience this Friday is a part of that fixed supply in action.
And Jason, have you made any changes, kind of pulled any levers in preparation for that halving for the business?
The preparation for a halving really comes years before it happens. So I would say Riot prepared for this halving by being focused on having a very low energy cost. In 2023, we had a energy cost of 2.2 cents per kilowatt hour. It's one of the lowest in the industries. And years ago, we started building a new facility that comes online this month. So this facility has expansion, and it's where we're deploying the latest, greatest, most efficient machines out on the market. So we prepared for this halving years ago, and the decisions we make today are us preparing for the halving that'll come 4 years from now in 2028.
Jason, help explain this to us, because when the halving happens, the amount of Bitcoin you will get for mining each Bitcoin will be about half what it is right now. And there is a limit that is half what it has been in terms of the amount of Bitcoin you can mine per day. How does that not just simply cut your revenue in half?
Well, it immediately does cut revenue in half for miners. So it's always a rough patch of volatility that we go through. But the fact is, if you look past on previous halvings, we have seen huge appreciations in price in the 12 to 18 months following the halving. And in fact, this case, it's a very unique circumstance. We've seen Bitcoin reach a new all-time high even before this halving has occurred. So the price appreciation in the first part of this year, following the approval of various Bitcoin ETFs, I think has really helped dampen the negative impact that the halving will have on miners, because we've already seen some upside from this. But going forward, I think that the effects that we're seeing on the ETFs in the marketplace are really compelling. These ETFs, you put Grayscale Bitcoin Trust aside, we've seen net inflows of about $27 billion in the 3 or so months since these ETFs have approved. These ETFs have today about half the assets under management that gold has after being around for almost 20 years. So I think there's a compelling investment thesis with Bitcoin. I think the world community is seeing that. And while the halving from a Bitcoin block reward perspective is a cut in half of our rewards, I think we're in a very bullish scenario for price appreciation in the years to come here.
Jason, what will the Bitcoin price have to be? Like, what's your break even when it comes to the level of Bitcoin post-halving?
So because we focus on such a low cost of power, we're prepared for periods of slumps in Bitcoin mining economics, like what a halving might have. If you look at the latest generation Bitcoin mining hardware right now, those machines have a break-even price of about $200 a megawatt hour. So when the halving occurs, that effectively gets cut in half to $100 a megawatt hour. And in Riot's case, our cost of power all in 2023 was $22 a megawatt hour. So even with the halving, we still have a healthy margin here, but we're still bullish on the future prospects of Bitcoin. That's why we hold so much Bitcoin on our balance sheet. And we believe mining economics will rebound following the halving in the 12, 18 months thereafter.
Jason, your stock hit a 52-week low today. It's down about 40% so far this year. Is there a part of your story, Jason, that you think investors just aren't really appreciating?
I think this whole market is new. So I think because of the ETFs, institutions have another vehicle to get exposure to Bitcoin before. So I think a lot of money is looking at this halving and thinking, hey, why? I don't know enough about mining to pick who's going to be the winner and loser on the other side of this. I want to just sit in Bitcoin and see how the halving plays out and see how miners perform post-halving. So I think that's one of the main reasons we've seen poor stock performance across the whole Bitcoin mining sector. I think our value proposition to investors is that through our low cost of power, we are effectively purchasing Bitcoin at a discount to its market price. We are getting leverage on Bitcoin, and we expect to have more outsized returns when the Bitcoin price appreciates. So I think there's a temporary slump around the Bitcoin mining stocks because of the halving. We saw something very similar in the prior halving. I believe the beta from Bitcoin mining stocks to Bitcoin was very low leading up to the halving in 2020. And then in the months thereafter, then continuing to 2021, that beta increased significantly. And it was a huge bull market for all of us. So the short answer is, I think there's money. A lot of money is pulled out of Bitcoin mining stocks and is kind of waiting and seeing who's going to be the strong performer on the other side of the halving.
Jason, it was great to have you on the show today. Thank you so much for joining us. Appreciate it.
Thank you, Josh.
General Motors is holding a news conference right now and announcing it's moving its headquarters. Yahoo Finance's Pras Subramanian is here with the very latest. Pras.
It's official. It's moving down the street from the Ren Center to a new development called the Hudson's Building. It's Dan Gilbert of Rocket Mortgage fame has a bunch of developments in the Detroit area. I think over 40 now. This is the biggest one, about a 1.4.
He's been on a buying spree.
Yeah, I mean, he's really into redeveloping Detroit. It's a $1.4 billion project. So GM will move from the Ren Center, its longtime home, that massive complex by the river, to the new facility here. It's going to have a tower, the second tallest tower in Detroit, behind only the Ren Center. They're going to be there in 2025. GM says that they'll still own, I think, the Ren Center or that space, and they're going to try to redevelop that in another manner with Dan Gilbert. But so far, just a new HQ for GM as it sort of enters this new phase of the company going into the 21st century.
And it's interesting that they have still decided, though, to stay in Detroit. They're the only major automaker left that's got its headquarters in Detroit. They have about 5,000 people at that headquarters downtown. So it's interesting that it's almost as though they're partnering with Gilbert to sort of still reinvest in the city.
Yeah, the connection to the Motor City is still a profoundly important one for GM. The history there for the company. You know, in Flint, Michigan is one of its biggest towns, and they sort of have abandoned that area now. Warren, Michigan is our big technology center. You mentioned Ford is in Dearborn. Stellantis is down in the suburbs there, not really much of a presence in Detroit. This is the only Motor City type company that's still there. So working with Dan Gilbert, obviously he's putting his money where his mouth is there with the developments. And Detroit has really come up a lot in the last few years. When I've been there before a few times, it's changed dramatically.
Yeah. If you look at some of the climate change estimates, Detroit's supposed to be one of the good places to be as the climate worsens.
Or warms up.
Yeah, exactly. I'm not a scientist, but I have read that. Thanks so much, Pras. Appreciate it. That'll do it for today's Yahoo Finance. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
Terminal 542 Bravo Juliet.
So we're at the downtown Manhattan heliport, and what we're going to do is we're going to take off.
Yeah.
All I want you to do is pull back with your right hand. That will make you go up. Just pull back hard. Yep, and there you go. Now you're flying.
I'm flying.
We're not actually flying above the Statue of Liberty. That's a simulator from Joby Aviation, which is used to train traditional pilots on how to fly this battery-powered aircraft. With the backing of Toyota and Delta, it's one of the largest companies looking to bring battery-powered air taxis to market. These aircraft are called eVTOLs, which stands for Electric Vertical Takeoff and Landing. At first glance, it may look like a helicopter with extra propellers on top, but unlike choppers, eVTOLs run off electricity rather than fuel.
This is for charging.
It took us about 6 minutes to get from JFK to downtown Manhattan.
Over $22 billion in investments over the last 20 years from names like Uber, Stellantis, and Honeywell have now made this kind of a commute closer than ever, thanks to advancements in eVTOL technology.
High-performance propeller blades that are very light.
In addition to Delta, major aerospace names like United and Boeing see the potential and have invested with the hopes of one day adding eVTOL rides to their list of offerings. Getting in now makes sense. One research firm estimates the air taxi market could be worth more than $65 billion by 2028. While the tech has proven to work, and it could be even closer to commercial launch in Europe, here in the US, regulation, lack of infrastructure, and customer affordability could be what keeps these companies from taking off. Yahoo Finance went inside Joby's 130,000 square foot assembly facility to learn more about how the company hopes their aircraft and their business strategy will win the air taxi race. This is what's next in the business of electric air taxis. Flying above traffic in a congested city sounds like fiction from the Jetsons. But air taxi companies believe they can make this a reality as soon as 2025.
This is as close as we've seen, I think, in terms of the technology coming together to make something that you could use on a daily basis to go where you want to go and do the things that you want to do, which is kind of what a car is all about, I think. That is something that's going to be practical and available to people in the pretty near term.
The Joby aircraft has completed more than 1,000 test flights. The aircraft can fly 5 people, including the pilot, up to 150 miles.
What can you do with the way you design and build an aircraft if you have a world-class electric propulsion system available, which no other aircraft have really been designed around in some ways?
The 6 motors on the aircraft are powered by 4 batteries, which were developed by a team of ex-Tesla employees.
What that lets you do is fly very, very efficiently, which makes all electric work.
And makes all electric safer, too. Redundancy was built into the aircraft. Everything has backups in place.
So this is a battery, this is a battery. Does that exist on the other side, too?
Correct. So the aircraft has got 4 batteries. You've got that redundancy. You can afford to, I mean, we can lose a battery and we still fly perfectly fine.
Electric aircraft face similar challenges to electric vehicles, which don't have the added hurdle of launching into the sky. Among those challenges, battery charging times. Joby can go up to 100 miles on a single charge, meaning it could do 2 trips back and forth to JFK from NYC's downtown heliport before needing a recharge. Joby says almost all of their trips in target markets would allow for recharging that takes about as long as deboarding and boarding passengers. According to one report, eVTOL batteries would ideally charge in under 10 minutes, about as fast as Tesla's latest superchargers. eVTOL companies hope safety measures will give them a leg up as they try and bite into the 10,000 traditional rotorcraft trips per day happening in the US. But first up, getting cleared to fly. A representative from the Federal Aviation Administration told Yahoo Finance that while eVTOLs could launch commercially as early as 2025, 2028 could be more realistic, at least for a scaled and competitive market. The FAA's Innovate 28 initiative outlines requirements for launch. That includes hitting certain safety criteria and flying under a variety of conditions. It's the same approach applied to traditional aviation. Still, certification is not guaranteed.
We don't know when certification for FAA will happen for any aircraft. The FAA changed them to special condition aircraft, essentially, putting more rigorous certification processes on top of that. So I can't imagine that we're going to see an eVTOL in the air certified flying around folks in 12 months' time.
Does pre-2030 seem realistic?
I do think late in this decade we'll have that.
Until then, eVTOLs are focusing on countries with looser regulations. Joby plans to launch flights in Dubai by 2025 through a deal that was supposed to be exclusive, though Archer, Joby's main competitor, later announced their own plans in the region. Back in the States, Joby's on track to hit the FAA's proposed timeline for approval. They've just completed stage 3 of a 5-stage trial. But with testing comes setbacks. The U.S. National Transportation Safety Board released a report on a Joby crash from February of 2022.
I know that there was a test flight that did end in a totaled Joby aircraft. Can you talk to me a little bit about what happened there and how you as a leader kind of transitioned the tech moving past that?
We were flying pretty high and really fast, right at the edge. We were doing it remotely though, so that's actually one of the really interesting early use cases of autonomy that I think is a little underappreciated. We've taken care of it in all of the future designs, but we found it earlier because of the use of that remote piloting and autonomy in a way that I think ultimately is pretty beneficial.
I think autonomous has its own issues, right? The fact that people will feel comfortable not only getting in an aircraft that they've never been on before and having it have no pilot seems like the riskiest proposition.
Still, autonomous flight could boost profits. Pilot salaries aren't public, but the average annual wage for commercial pilots in 2022 was a little over $100,000. That's according to the Bureau of Labor Statistics.
We think that's definitely going to come. We just don't think it's the right way to go to market to start with.
Sure.
Because this gets us to market as fast as possible. And then that's something that will make it even better down the road.
For now, Joby is partnering with companies like Toyota and even Uber, which sold off their own air taxi unit to Joby back in 2019.
I led the Uber Elevate team, which was Uber's effort to build a flying car, in some sense, ecosystem of different companies. We actually demoed this with helicopters in New York City in 2019 when we launched. Maybe you remember there was something called Uber Copter. You'll be able to in our app or in the Uber app, essentially choose Joby, a Joby flight, as one of the types of products. But it won't just be a flight alone, it's actually a multimodal integration.
That integration will be needed since Joby won't have many locations available for flights at the start. Here's how it would work in one of their first target markets, New York City. Users would open the Uber app and select the air taxi option. Then a car would come to the customer's door, drive them to the nearest vertiport, which is a converted heliport that can handle the charging and storing of eVTOLs. From there, users would hop in the eVTOL and land at a nearby airport. Joby says in New York City, the flight would take about 7 minutes. Uber isn't the only major company getting in on the action. Toyota invested nearly $400 million into Joby, and Delta invested $60 million. Archer, Joby's biggest competitor, has a $1 billion conditional order from United Airlines and raked in $150 million from Stellantis, as well as some well-known investors, including Cathie Wood via her ARC Innovation ETF and serial entrepreneur Mark Lorry. Major air taxi firms Joby, Archer, and Lilium have all had gains on the S&P 500 this year. To see this investment put to work, Yahoo Finance went inside Joby's assembly facility, which, following the Toyota investment, now runs a lot like a car assembly line.
So this overall is our final assembly facility. So we are bringing in all sorts of parts, all of the many different parts that go into the aircraft. Many of them get built here, and then we have a process where we put them sequentially in the right order, in some sense, onto the aircraft to build out that full aircraft. We are vertically integrated. We build the parts, and then we assemble the parts together into structures. And so what we have behind us is one of our structural assemblies for a fuselage, which is the body, the main body of the aircraft.
That vertical integration is part of what attracted Delta to Joby.
We spent at least 18 months looking at over 20 different eVTOL startups, really looking at what each one had to offer. Because of the technological strength that Joby had, the financial strength that they had as a startup, we felt that that made a great match for us to be able to collaborate.
It's not just airlines chasing the future of aviation. Honeywell, broadly known for things like thermostats, has an aerospace unit that's now making parts for eVTOLs.
What they've done is basically taken their partnerships onto eVTOLs by becoming a supplier. And that sounds like big investment dollars from Honeywell, but not so much because they're not touching their 27% operating margins. But instead, what the company has done is tell partners that if they would like Honeywell to partner with them, they could invest in Honeywell's product innovation. We don't know the background of those agreements.
For major airline carriers like Delta, future investments into Joby are based on them achieving regulatory and financial milestones.
We have specific performance criteria. For us, it really is the performance metrics is just getting them to market and making sure that we're comfortable and integrating a seamless experience for our customers.
There's more than one path to get this to market. Rather than partnering with airlines, some eVTOL companies like Lilium are looking to sell to them directly. The German-based business, which offers a larger 7-person eVTOL, plans to focus its efforts on manufacturing and maintaining its aircrafts instead of owning the end-to-end experience like Joby. Regardless of the business model or investors, some common obstacles exist for all eVTOL companies, including infrastructure and adoption of the over 6,000 heliports in the country. New York City is poised to be the first to transition one into a vertiport for eVTOLs. The effort's not cheap, though. One firm's model suggests costs could range anywhere from $3.5 million to $12 million for a leading global city. Of course, that depends on a variety of factors like size and location.
What we are looking to do on this site with a number of eVTOLs is how do we embrace new technology, pivot to all electric, significantly reduce noise pollution.
So the end goal is a full pivot.
The end goal is a full pivot.
Infrastructure operators are putting in bids to transition this heliport into an electrified vertiport, one of 2 operated by the city. The plan is to convert both within a year of FAA certification, according to the mayor's office.
We won a very significant federal award, so some money will come from them. Some money will come from the bidders, who will have a long-term contract to manage the site, and some will come from the EDC.
Once they get FAA approval and find a way to build up vertiports, the next obstacle for the industry, scaling enough to keep costs down for riders.
So our goal is to actually launch this service at something like Uber Black pricing. On a per seat basis, though, not on a per vehicle basis. We think that as we are able to build up those muscles, the way the technology is able to efficiently batch people into the aircraft and make the whole operation work more and more efficiently, we'll be able to drive down toward Uber X-like pricing on a per seat basis. And we think that really starts to get into that realm of like everyday flight.
According to Uber, the average price of a trip from Manhattan to JFK is $135 for an Uber Black and $87 for a regular Uber. However, Jeffries estimates that at launch, that Joby ride could cost around $200.
Do you have an idea of how many flights per day, per week?
Yeah, we haven't really announced any of the details on that.
One consulting firm estimates the cost per passenger kilometer will decrease by more than 2/3 between 2025 and 2040. But that's partially due to an expectation of autonomous flights in the future, which isn't without its own set of challenges.
So monitoring the FAA certification is the number one. What are the number 2 and number 3 headwinds that investors should be thinking about for eVTOLs?
Second would be infrastructure. I think we don't have an infrastructure in place right now, really. Where could you take this aircraft from? Could you take it from on top of your building? Will your building have the infrastructure for it? If you have to commute 30 minutes to the terminal that has it, does that defeat the purpose of just taking the Uber? Third, I think it's just customer apprehension to try an eVTOL. We just seek more customer awareness.
Joby detailed these headwinds and many more in an SEC regulatory filing from February. The company notes they have enough cash on hand to support the initial launch of commercial operations in 2025. But after that, if they're not generating sufficient cash flow, they'll use a combination of equity and debt financing to fund the business. Despite the financial obstacles and competition, if the eVTOL industry gains adoption, it has the potential to transform the way we travel, and that goes beyond just how we get to and from the airport.
It's easy to be negative on an industry that hasn't really taken off yet, right? So we want to be supportive of innovation, we want to be supportive of technology, but we also want to be cognizant of the current regulatory environment.
There'll be other things that we can do with these technologies that we're certifying. We're really building toward the future in a lot of ways as well. We're building all of these capabilities, all of these muscles as a company, not just to build one revolutionary airplane, but to build the future of zero-emission aviation.